My name is Rafał Celej. I'm a founder and a partner of a boutique law firm Kondracki Celej based in Warsaw in Poland, advising on venture capital and startup transactions. I have great pleasure of hosting this fantastic panel on term sheet market standard and practices with exceptional guests. Glenn Waters, founder and head of PwC Raise Ventures with over 15 years of experience. Glenn advised on over 100 PE and VC-backed deals across tech industries. James Lewis, partner at Persidas LP, a consulting company advising on venture-backed businesses. And Charles Theed, CEO and co-founder of Zapnito, a knowledge-sharing network platform company. Term sheets seem to be one of the most important and focal documents in every venture capital transaction. Good understanding of terms and nuances is really important for the founders and the startups in getting a good deal or a decent deal, because term sheets will lay the grounds for a future relationship with their investors. We as lawyers, usually when advising on either startup or founder side or investor side, we usually refer to something called market standards. But market standards can be interpreted in a different way. What are these market standards? PwC conducted a survey of over 163 term sheets in 2020. The results of the survey will be presented in PwC's report, but right now you have the exclusive opportunity of finding the key summaries and key findings of the report, which will perhaps at the end of the panel make you understand what are these standards. Glenn, I head over to you for presenting the summary.
Thank you. So, hi all, I'm delighted I could be here with you today. So I lead the PwC Raise Ventures team, and we help fast growth companies get investor ready, connect them to investors, and help negotiate the commercial aspects of a term sheet. So from our experience and our privileged position at being in the middle of a fundraising process, one of the most difficult aspects about the process for entrepreneurs is getting a term sheet. It's the holy grail. The term sheet is critical as it usually determines the final structure of an investment. It is not a letter of intent, but a blueprint for your future relationship with your investor. What we often found when talking to both entrepreneurs and investors is that what was considered market was based on personal experiences and was subjective. As a result, to increase transparency in the ecosystem, both for investors and entrepreneurs, we produce an annual independent market report and term sheets. So the key highlights from the term sheet report I'm about to go through was based on 163 anonymized final term sheets issued in 2020. And these ranged in investment size from £500,000 to 50 million, both in the UK and across Europe. So we've categorized these as seed investments, so less than 1 million, Series A 1 to 10, Series B 10 to 30, and Series C 30 plus. The investment was from a range of investors, including traditional VCs and family offices, as well as EIS and VCT funds that are tax funds specific to the UK venture ecosystem. Now I'd personally like to thank Alistair Hamilton from Shoesmiths, Brian Shaw from MBM, David Strong from Marriott Harrison, Henry Humphreys from Humphreys Law, Howard Watt from Sheridan's, Phil Robinson from Ignition Law, and Ian Moore from Taylor Wessing, who participated in the survey and made it happen again this year. Okay, so now I'm going to go through some of the key highlights of the survey. So this session is not meant to be a technical guide to what these terms mean. Now that can be another session. But when looking at a VC term sheet, we look at it from an economics and control perspective. So liquidation preference. After valuation, which is a whole separate discussion, the most important term in a term sheet is structure, and specifically the liquidation preference. We found it was market for an investor to have some form of downside protection, with 72% of term sheets having some form of preferred shares. Where there was a preferred share, the market in nearly 70% of cases was non-participating, i.e., this is where an investor has a choice. Their investment money back first, ahead of the other shareholders, or the investor participating as an ordinary shareholder on a pro rata basis. Just over 30% of deals had a participating structure. This is a double dip, where the investor gets their investment amount back first, and in addition, then participates on a pro rata basis on the remaining exit proceeds. So very investor friendly. When we look deep into the data, preferred participation was mainly seen in investments from UK tax efficient funds, i.e. EIS and VCT funds, where downside protection for their retail investors is key. But the money multiple return required on their investment could be only 3 or 4x, as opposed to 10x, often quoted by a traditional VC. So liquidation multiples. So linked to the liquidation preference is the liquidation multiple, i.e. how many times back the investor gets on their money. For both non-participating and participating, 1x was market. Although some might say outrageously in 11% of the term sheets, there was a participating structure with a 2x or more multiple. I think the key thing for a founder when it comes to liquidation preferences and multiples is the need to consider it in conjunction with other terms. What you really need to do as an entrepreneurial founder is look at your exit waterfall. So you might own, say, 35% of a business, and this is what you think you're going to get in your pocket at exit. But in reality, this could be very different depending on the preference stack, and analysing how much you get at various exit stages with different clauses is key. And often we see a lower valuation with the right structure can lead to better outcomes. So moving on to the comparative, so 2020 versus 2019. So when we compared 2020 to 2019, i.e. the pre-COVID world, one might initially have expected terms to become more aggressive. And this is not what we've seen. In fact, for businesses in the right sector, particularly SaaS businesses, there's been a lot of money fighting for quality assets, leading to an all-time high in valuations. As a result of this competitive situation, there was a greater percentage of term sheets being issued with a simple ordinary structure than was the case in 2019. And where there was a preferred structure being issued, the percentage of non-participating versus participating and the liquidation multiple in 2020 were in line with 2019. So that's the next slide. So you can see there no real difference between 19 and 20. So if we move now on to other economic terms, 20% of transactions involve tranched investments. 45% of deals saw an anti-dilution provision. This protects the preferred shareholder by preserving their ownership percentage in the event of a down round. And 67% of term sheets included a restrictive covenant post-departure. And where there was a covenant, in 84% of cases, the duration was a 12-month period. Moving to the graph at the bottom left, so arrangement fees. 69% of term sheets did not have an investor arrangement fee. And where in the 31% they did, 2 to 3% was seen as market standard as the arrangement fee percentage. On the right-hand side, that pie chart, ongoing monitoring fees, these were seen in just over 30% of deals. And these were typically based on an investor director fee ranging from 20 to 30,000 per annum. So now, before we get into some of the findings on control, it's worth pointing out that VC investors are minority investors, and therefore they require some form of minority protection. So that first graph on the left-hand side, what we saw was in 85% of term sheets, the investor took a board seat. In 39% of deals, there was a right to appoint both an investor director and a non-voting observer to the board. And surprisingly, in nearly 10% of deals, the investor had the right to appoint 2 board seats. That graph on the right-hand side, so this shows the minimum threshold to hold an investor board seat. And this was specified in 35% of term sheets. And where it was specified, 5% of the fully diluted equity can be considered as market, although 10% wasn't uncommon. So leaver provisions. So this is a really emotive one for founders. where interestingly 40% of term sheets were silent on leaver provisions. And these were negotiated as part of the long form documents after the final term sheet had been signed. And the company was in exclusivity with the investor. And where they were specified in the term sheet, which was 60% of the cases, there was a requirement for a departing founder to relinquish some, if not all of their shares, depending on the type of leaver they were. And a good bad leaver was the most common scenario. So now moving on to founder vesting provisions. So what we can see here, in 56% of term sheets, there was a founder vesting clause. Again, a really emotive one for founders. So this is where the founder earns their shares back over time. And this clause is used by investors to help ensure key management and founders don't leave the business after an investment has been made. They are investing in the team, so it's key to keep them in the business. And where vesting was specified, so 91 term sheets, so this is the right-hand side graph, no pre-vesting was the most common scenario on day one. With 25% or less pre-vested, i.e. already earned on day one, the next most common scenario. Now, surprisingly, when we did a deeper dive into the data, the results didn't vary much between seed and Series B. That really surprised me. In terms of the time to earn back these shares, the vesting period was typically over a 3 to 4 year period on a straight line basis. So, okay, I know that was a quick rattle through, but that sums up some of the key highlights of our term sheet report. As mentioned at the start, we will be releasing the full report in April, and it will show analysis by seed, Series A and Series B, as well as by investor type. And further findings will be published on LinkedIn, but do get in touch if you want to see more details.
Fantastic. Thank you so much, Glenn, for that presentation. It's really, really insightful. So maybe now I'll start with James. What are your thoughts on that? What key findings of the survey surprised you the most?
It's funny to see that how often leaver provisions aren't mentioned in term sheets. Partly because I think at the moment there's lots of platforms such as Seed Legals that are starting to put those out there straight away, and conversations you can have sort of at the outset. And as Glenn says, it's a pretty emotive conversation, and you kind of want to have that done before you end up, sorry I say this quietly, paying for lawyers to argue it for you, which is a sort of huge, in my view, a bit of a waste of money. But you can if you get that done from word go, then the other thing I think you get from that is a sort of good chance to see how the other side negotiates sort of face to face. And as I say, if you're doing it through a kind of post-box lawyer thing, all you get is kind of angst and anger, when you can just sit and have a proper conversation and say, look, this is why I want it. This is why it's good for you. This is why it's bad for you. Often when you've got co-founders in there, there's you've got to protect you from a co-founder leaving as well. So you can argue sort of both sides of it. And then the only other thing I'd just quickly say, I was interested to see that I would have thought there'd be more participation preferences in structures, especially in light of valuations going up, where people are trying to protect their returns, and the sort of COVID sort of world where valuations, bizarrely are going up, but that's because there's lack of place to put your capital, I guess. So yeah, I was interested to see that, and it's good for founders, really.
Glenn, you've analyzed all those term sheets. What are your thoughts on this whole survey?
Yeah, I thought it was really interesting what James said actually on the negotiation between founder and investor. I mean, one of the key things we do is, after sort of doing the commercial review of the term sheet, we think it's really key for the founder and investor to be in the room together, and I think develop a relationship there and see how each other act. But yeah, coming back to the survey, I think the move towards ordinary shares I thought was really surprising, given the increase in valuation. So I concur with James on that. And I think also what was really surprising was the number of 2 times and 3 times participating preferences out there. I had a look at the data and I can say it wasn't James, but yeah, I mean, I'd be interested to really get into that data and see, is it because the valuations were crazy that they've got such a punchy preference?
Thank you. Charles, you're a founder. I mean, can you please tell us how your fundraising process went? How did you get equipped for getting your best deal, and how did you prepare for term sheet negotiations?
Sure. Yeah. I guess there's three experts on this call, and I'm not an expert in term sheets. So I think one of the things that, I guess in terms of our journey, we've been mostly self-funded but angel-backed startup, and we were looking to raise closer to Q3 this year to do a little bit of a larger raise. And COVID accelerated what we are doing, which is communities, future of work, and knowledge sharing capabilities. So we had to move very quickly to get going. And I think there was a little bit of serendipity in that we had applied for the PwC Raise program. So that came in right at the exact time that we decided to accelerate our Series A. I would say, knowing that we were doing that, besides the PwC Raise program, I was talking to friends that were CEO co-founders. That was really helpful, just really kind of grilling them on their experience. Also talking to our advisors, our investors that have been through this, and really starting to educate ourselves on the process, because there's a lot of information which we just covered that is new to first-time founders and potentially even second-time founders. Things are changing, things are shifting. So I think just getting the right partner as well, just the right advisor. So we found that with PwC, definitely.
Yes, that's for sure. Good advisors and term sheets, and the whole deal is crucial. James, as an investor, how do you and your team approach the term sheets, drawing up the term sheets? Do you have a standard that you apply across all the deals, or each deal is bespoke? How do you negotiate that?
I think everything candidly ends up bespoke. You might start from a template position. I mean, we're a family office, so we have lots of kind of different angles that we look at things from, and different types of investments, from sort of very early stage where you might get involved with a convertible loan note, or whatever it is, and then to later stage ones where there are sort of stricter term sheets and different. I guess if you're a seed fund, you're doing 5 to 10 deals a year, you've got to have a template, because you won't get through the volume enough unless you stick to what you know. And my previous firm, we had a couple of templates. The challenge is they always get kind of shifting with time. What becomes market one week is something else, and what you can sell to different founders. It could kind of come back to the bit that I think it's a really important bit of the process to learn how each other works. And you're going to spend 5, 7, maybe 10 years looking at these people once a month, once a quarter over a board table. And it's a really good opportunity just to kind of, feel out how they deal with pressure, how they deal with difficult conversations, how they deal with bad news, good news, all this kind of stuff. I think you can get out straight away. And it's kind of like a very intensified period, because once you've done the deal, you end up, everyone's happy for 6 months, and then who knows what happens? It goes well, it goes badly, whatever. Then you have different conversations. So I think it's a very helpful bit of the process anyway. But because of that, it ends up bespoke.
Okay, true that. I mean, no deal is the same. If you could elaborate a little bit more on what are the key influences on deciding on what clauses do you include or not, or how do you approach them in the term sheet? How do you shape thinking around this? I mean, talking about metrics, downside protections, or other factors.
Yeah, each deal would have slightly different factors to it. If you looked at maybe a sort of very fast growth one, you might not have the same thing as if it's a sort of slightly slower growth where you want maybe a bit more downside protection. And certainly with the sort of the tax funds in the UK, which is where I was previously, you'd look at that, and that would sort of make you push towards a participating preference. There's also, I think, in my view, a bit of a disconnect between the valuation the valuation metrics that people are using. So you see them going up quite a lot at the moment. And that's fine in the public markets where people are kind of chasing growth shares. In the private market, slightly different. And if you're sort of playing the odds, you're not going to sell the business on those multiples particularly. You're going to sell them for a lot less. So putting in a preference gives you that sort of boosted return. Where we like, as a sort of house style, we like to have a little bit of influence. So we'll have an observer right, or candidly, I'm less keen on director rights now. I kind of quite prefer observer to be close and to be chatting to people. All the minority protections, very keen on protecting us from later money coming in and swamping us out and crushing us in various things, which we've seen a couple of times, and where things catch hold. So we'll be quite cautious on those areas. But I mean, it's not particularly different to, you can spend a couple of hours on Seed Legals and look at all the boxes and tick all the boxes there and see what comes out. And again, getting good advice is key. The worst deals that I've done have been with not very good legal advisors who might be very good at what they do, but aren't doing this every day. And I think you come back to this conversation about market standards. If you're seeing them every day, you know what broadly the realms are, and great surveys like this show you where they are. And having someone to say, look, don't worry about that. That's kind of normal. This is how you deal with it. This is where you can get to. Like, it just speeds up the process and actually takes a lot of the aggravation out of it really, really quickly.
I absolutely fully agree with that. Most of our clients always say that it's not only about the legals, but also the business approach of the lawyers. So I fully agree with that. So Glenn, Charles mentioned briefly that they applied to PwC Raise, and you were very helpful. If you could tell us, how do you make the process more efficient on your client's behalf? So many different terms that could be negotiated in different ways. As we mentioned, no deal is the same. So how do you approach that? What is the benefit? And
yeah, sure. I mean, I suppose before we even get to a term sheet, it's sort of working with the founders and the team to sort of articulate the equity story. I think I'll let Charles come in a minute. I mean, getting a term sheet is bloody hard. So it's actually, what is the elevator pitch? Have you got your docs prepared? What's the equity story? Have you got a free statement financial model? I think we're seeing Series A very much metric driven. So can you articulate your data? And then when you're moving into this sort of investor process, so before that term sheet lands, it's effectively understanding which investors are going to be suited to which founders. Are you a unicorn type of business, or are you a nice steady growth business, which will then determine which type of investor you go to. And I think also for the founder to know what previous investments the investor has done, where they are in their fund life cycle, I think is really critical. I mean, where we see the process going wrong is where there's a spray and pray approach, where decks are just sent out to hundreds of investors with no real clarity of why they've gone out. And then I think coming back to the term sheet, I think it's educating the founder, entrepreneurs, what the key clauses are, what's relevant for them. Some founders want the valuation and love the vanity of evaluation, but that might mean they get a more difficult structure. And others will actually sort of stand back and say, actually, I prefer a simple structure with a lower valuation. So it's sort of giving up front that education piece, because I think there's a lot of asymmetry of information to the founders and entrepreneurs.
That's really fantastic added value, I must say. One more question to you from your perspective, based on your experience in so many term sheets that you have analyzed. What are the immediate red flags that you see in term sheets when founders come to you with the proposals that they have?
Yeah, I mean, you can, in 2 minutes, you can tell whether it's a good or bad term sheet. So clearly, the structure, the valuation, I think the option pool, that's quite a bugbear for me. It's where that sort of option pool shuffle, as long as the founder understands why that's happened, because it's very theoretical, but there's arguments for both sides. Should the option pool be created before the investment, or should it be created after an investment? And as long as it's a fair debate, that's fine, but that's always one I see slip in. What else? And then control of the board, I think, is an important one. So often the swamping rights, which James alluded to, and how many board seats. So, I mean, very quickly, if you know that those 4 or 5 key things to look for, you can quickly assess whether it's going to be a good deal or not.
And would you say that this 2x, 3x participating liquid pref is a red flag?
Massive red flag. I have seen it often, and we've warned entrepreneurs, but they've wanted the higher valuation. And to be fair, a lot of our investor contacts where we've spoken to them and the entrepreneur has wanted a certain valuation, and the only way for the investor to make it work is put in that structure. So as long as everybody's clear why that structure is put in, then that's okay. But I think off the bat, if you go in with a low valuation and a really difficult structure, that's a big red flag. But yeah, so I think it's just having the knowledge. Do you really want a super, super high valuation? And for an investor to get there, to make their returns, they're going to have to put in an aggressive structure. So it's a balance. So it's not just the investor. I think the founder has to realize and manage their expectations.
All right. Charles, if I may ask you, you probably have or had a lot of options on the table. So when you got all those term sheets from VCs and other investors, what did you look at in making your decision? What was the most important factor for you?
So I think there's two sides to this, right? So James alluded to the one side, which is, can you work together? Is there a rapport? How do you interact? I think so. What we did was we really looked at what are the sticking points for us on the tangibles, if you will. So the preferences, the valuation, the lever clauses, all the stuff that's easily defined but needs a lot of education around. And the second piece was really understanding how they interact as well from the beginning. So if they get the business, they get the idea, they get the market from day one, I think that's really important that they get it. If you're trying to sell the market and the market potential too much, then I think that's a red flag if they don't understand the product and the opportunity. So I think from day one, you get a sense of maybe more the intangible stuff. So I think the key things for us as founders, which might be different, would be different for others, was the reverse vesting was a big part of it. So we had obviously put in our own money and lots of sweat and to be bootstrapped and self-funded. So that was a big sticking point, as opposed to the valuation. We weren't looking for unicorn valuations at this point. We really wanted to focus on that. And then I think just as a point around the option pool that Glenn mentioned, I think it's really important to make sure that you have your options and you have the room for your options before you even start the conversation, just to make sure what the implications are on the option pool, how much option you actually have left for your future employees. So I'd say there was probably 3 key points for us. It was about collaboration, support, the reverse vesting, and also the board itself and the structure. But for me, it was a lot about the rapport we had with the investor. That was because, to James's point, it was 5 to 7 years, and I think it's really important that you get along from day one.
Absolutely, and usually, you negotiate agreements intensively, but you look at them only when bad things happen. So if you maintain great relationship, nobody remembers about the deal terms. One more question to you, Charles. Glenn mentioned a few red flags, immediate red flags that they identify at PwC. Would you say that these would be deal breakers for you? Taking aside great relationship with the investor.
Such as what? What do you mean, the ones I mentioned, or
no, the others? For example, like liquid pref, double dipping.
Yeah, I think you're kind of in this weird scenario where you're thinking about today, but you're also thinking about 5 years out. So I think the waterfall helps you think about 5 years out. It's very hard to do. There's a lot of things that are going to happen. Are you going for your Series B, your Series C? So definitely when you see the waterfall, you can start to see, okay, am I comfortable with that? In my future state of being, at whatever ARR you're going for. So definitely, I think those are deal breakers, but it's really helpful to see how they play out. Because if, I think emotively, like if you just understand the double dip, that doesn't sound right. But if you see how it plays out in the waterfall, then I think it just makes it much more clear and takes away that emotion, and then you make that decision. So definitely, I would say 2 times would be, a problem for us. And but I think let the waterfall do the job, and you'll know what feels right. I think that's probably the most helpful thing that came out of this, or one of the most helpful things.
Fair enough. James, Glenn, last year I had the pleasure of hosting another investment panel. It was exactly at the outbreak of the pandemics, and we were discussing with VCs and the founders what could be the impact of the COVID-19 on VC deals, and especially on terms and valuations. Based on the last 12 months, what impact have you seen on the term sheets of the pandemic? Maybe starting with James.
It's interesting because I think it's that 12 months isn't a consistent period, right? So I think initially there was a lot of it's going to be 3 weeks. We'll be fine. We'll be back to normal in 3 weeks. So you kind of hold on to your hats for a bit and see what happens. And then as we kind of saw that was going to take a lot longer, you're like, okay, well, let's get used to how this all fits together. And actually, we did 2 or 3 deals last year without meeting people, which is just getting used to doing those kind of things. And candidly, I long for those kind of things. I like the relationship side of meeting people, understanding how they react over a longer period of time. I quite like going out to have something to eat with somebody and kind of seeing how we are normally together, and what do you think we can work together? So those things have kind of I think have had an impact, and probably taken a bit longer to get comfortable with teams for me. I know others are doing things much quicker, and if you've got a fund that needs deploying, you've got to deploy a fund. So that's sort of slightly different. In terms of term sheets, I think it's probably taken me just a little bit longer to get to them. But in terms of what we put in the term sheets, I don't think that's materially changed now. I think there's still plenty of money in the market. I think, there's plenty of money looking for deals. There's plenty of money doing deals. And so that has kind of pushed business as usual a bit more in my view.
Glenn?
Yeah, following up on that, I concur with what James was talking about. I think 2019 was sort of a very strange year, a bit of an understatement there. But what we saw when COVID hit, the market just seized up, and we saw companies which did have term sheets, them either getting pulled or the deal terms changing massively. So we did see structures sort of move from, say, an ordinary share to a 1, 2, even 3 times participating, because everyone was like, what is going on here? But I think as we sort of as deals moved to a virtual environment and we realized this was here to stay, we saw a lot of deals. So from September onwards, the market has been really, really crazy. Us personally, we're the busiest we've ever been. Q1, we've completed 6 deals. We've got another 2 deals just about to complete. But what we've seen is actually, and I think the report sort of alluded to it, people have got used to this world. They've got used to doing deals virtually. Yes, it can be harder where you can't really get that intangible bit, but where investors have got money to deploy, actually doing deals virtually has sped things up in certain instances, particularly around the diligence phase. But then, in terms of term sheets, I haven't seen a material change apart from that period just when the first lockdown happened. But since then, if I compare pre-COVID to now, I'd say term sheets are pretty similar in terms of their clauses.
One of the takeaways from our discussion last year was that the investors may be very aggressive on the valuations. Would you say that this has materialized, or is it actually contrary?
The opposite. I think if you saw that graph in the in the presentation, I think for the right assets. So if you are a quality asset, it's very competitive out there, and that's driving up prices. And that's why I think there's been a shift in terms of structure. So if you're a really, really good quality company, now's a great time to be fundraising because there's so much money out there. It's a lot of dry powder.
It feels like size of funding rounds has grown as well. So there's some data I'd love to see about those. And then the other bit is I think is how the impact of the future fund kind of rounds will feed out into the UK market, which is very specific to the UK though.
Would you also say that because of the competitiveness of the market and great assets on the market and what is happening right now, that investors have to be more founders friendly right now?
Yeah. In short, yes. I mean, if you want to win that deal, I think there's obviously, I think, and James in a better position to sort of articulate, but I think each house has their sort of parameters they can move. There'll be this, let's call it the standard template term sheet, and each house will have a sort of bandwidth where they can move on clauses and positions. And what we're seeing is, typically off the bat, them given a pretty friendly term sheet because they really want to win the deal. And that's been pretty good, actually, because it stops the back and forth. It's like, look, this is our best offer, put forward. And I think it helps the founder because it sort of reduces the time and sort of the back and forth. But I mean, James, someone doing it day in, day out and issuing.
Yeah, we've seen some very friendly ones, and as you say, the people in good positions can probably dictate their terms. Good growth, good. And then there are others that have struggled. So actually, there's the other side of it, where maybe some of those 3x prefs are, where there have been companies that have kind of ran out of cash just at the wrong time, or were trying to fundraise in that period where people kind of paused, and that might have prompted some of the nastier preferences and nastier things that came out. But I think if you kind of look in general at the market, there's a lot of money chasing deals. Rounds are bigger because candidly costs are higher. And it's probably not going to get any. It's not going to get cheaper, right? Inflation's on its way. We're left, right, centre. So. Raising rounds to give you enough runway to go and do things seems really sensible right now while money's available. The only thing you kind of worry about slightly is that, if you're raising at these higher valuations, you've got to grow into them as a company. And, if you miss a couple of steps and you're having to go back out to market, you just have to be conscious about how that looks and feels. But, good businesses will always raise capital, in my view.
Yeah, I think that's a great point. One of the things a founder and entrepreneur has to think about is what does their cap table look like for the future? So who are the investors on that cap coming onto that cap table, and what structure has been put in? Because what you agree today, a future investor is going to want that, if not more. So you need to be careful about that.
I guess that Charles would fully agree to that. So if you could just, because we're probably running out of time for the panel, if you could just, Charles, briefly say what were the key takeaways as a founder that you've learned throughout the fundraising process that you could share?
Sure,
with the
I have
audience?
a long list, but I'll keep it short. So I think probably the biggest is just be ready. Know what type of VC you want to work with, what makes sense to you. Really understand that. Talk to as many founders and co-founders that you can that have been through that process, and hear about the good, bad, and ugly of the process. I think definitely the advisors, having the right advisors, specialists like the lawyers. If you can get a great advisor like PwC, arm yourself with those. And then I think also the last thing is the investors want the same thing as you. They want to back a awesome high growth business, and so really treat it as a collaborative process, and you'll get a sense of the investor partner through that. So I guess those would be things. The waterfall cap table, as Glenn mentioned, there's just a lot of education that needs to happen, but also just make sure that you do kind of an audit of your business, that you're ready to make that happen.
Thank you. In general, I would like to thank all of you because I think we're out of time. I think that we had a very insightful discussion. myself, I've learned a lot of new things that I would be able to employ in my negotiation strategies. So thank you so much, Glenn, for the presentation, and James, Charles, for fantastic discussion.
Pleasure.
Cheers.
Thank you so much.